Hello friends, this day we are going to dissect some of the trade analogy. When you see a trick play in the chart, take note of that area. See, market pushed strong up, then reversed it. When market price come to that area again, it's like the same play, try to go up, but somebody shot and killed those birds. So let's mark that area. So these are the areas where you can take really good trades with a very little stop. But these areas hold a very large significance. When you go forward, you will see that. Okay, let me put 2000 forward. Okay, let's go to the recent history. See, market reversed there. You know, such areas hold large significance. So whenever you see a dramatic move from this kind of area, dramatic moves, you should take note of those areas and mark them in the charts. So some of you are skeptical about the working of working of technical analysis, but today I will show you one example which works always beautifully. See, we have a significant low here, and this is a pure demand zone. Whenever price come to that area, it bounced, but this bounce was not so strong. So some people were skeptical. So they came back to this demand zone again in the form of a compression. If you look, if you look at the previous videos, you will see in the explanation of compression, and I'm really copying or identifying and or using their methodology. There means RTM, readthemarket.com. They are pretty good guys. They put lot of information free for people, in the out. So this is the tip of compression. Maybe this we can call it as a this is the MBL. Once price break this area, it is free to go up. But when it runs out of the momentum, it needs to come back for a refill, recharge. So why this is a compression? See, price goes down, then came back and pick up the leftover orders at this excuse me MBL area. Then price came back, shot down, and came back and picked up the orders here. When then it goes to the demand. It's a way of testing in the demand, in the strength of the demand. So it is a way of testing. If you read the Jesse Livermore materials, they don't straight away jump. They test and Wyckoff methods. They test several times to make sure there are enough support or orders at the demand area. So once price, so this is the compression, this is the pre-compression area. So let's mark this MBL. From here, these all zones were retested. See, this one came back and took the orders, this one came, but here didn't come back to that the top. So This is the pre-compression. Our compression begins somewhere here and ends somewhere here. This is the real compression. The compression has two parts: tip of compression, compression, and pre-compression. Once price shot into the pre-compression area, it goes to the tip of compression. If it is goes above to that area, it's really strong. The movement is likely to go so strong, but it needs to come back. Where it is going to come back, either to the tip or pre-compression area. So you mark the pre-compression area. Pre-compression. So when price leaves this zone, it is very likely to create a small kickback here. Let's see if it is there or not. Okay, there are some attempt to push the market down. So you really need to take care of all this, you know, into your account before you commit, before you dip your fingers into the market table or throw your chips on the table. So when price comes back to this, I'll remove this. No, I'll keep it and I will make it fade. Otherwise, we will lose the reference. When price comes back to this pre-compression, you can take a trade very happily, and you will have very negligible stop. Very negligible stop, and you will get a massive risk reward, and too very quick. So we always need to look for the symmetry. So we will be targeting this top or this top. It's up to you guys where you are going to target. This is one of the areas where you can take trade with a very little stop loss and make lots of money. So those who are skeptical of technical analysis, this is going to work. This is similar to the R. Elliott's, who is the pioneer of technical engine diagonal. When first wave comes down, okay, let me put that quickly. Engine diagonal is an impulsive or diagonal. Okay, second wave, third. One of Elliott's rule is fourth wave shouldn't enter into the area territory of wave 2. But if it comes to wave 2 area, it is called in diagonal. There are two diagonals, leading diagonals, ending diagonals. Okay. So let's mark it and make a distinction out of that. 1, 2, 3, 4, 5. When making wave 4, if market enters into the areas of wave 2, then we call it as ending diagonal. Ending diagonals often indicates end of the trend, or leading diagonals often indicate the beginning of the trends. So this is how you identify the compression or ending diagonal. See, when the market breaks wave 1 and comes back really close to wave 2 or the supply zone of wave 2, then you can classify them as a ending diagonal. So on return, if price engulf the supply zone of wave 4, wave 5, okay, the supply zone in the wave 4 or a persona wave 5, you can be certain that the price should be going to the tip of conversion, tip of diagonal. In case if it is goes further, uh, when it comes back, this is a really strong area for a good bounce. So you can happily take the trade. When price left this way for it formed a kickback here. You know, this can be called as FTR because this is a significant. This is a high or a barrier. It breaks, but but barrier didn't stop the trend and it didn't come back. So this is really an FTR. Going to return. So you can take a trade happily with a tiny stop loss below the safety R and make lots of money. This is all about the compression trade. So thanks for watching. Have a good day. Bye bye.